Are you looking to start investing in mutual funds? Theoretically speaking, did you search types of mutual funds on the internet? If yes, you have clicked on the right thumbnail. Hit the like button as a little reward for yourself. I don't blame you though. Most new mutual fund investors ask this question while starting their investment journey. But will these lists online really make you choose the right funds and make you rich? Think about it. Mostly it would take you to some websites with ready-made lists. Most often these schemes may be shortlisted on the basis of their short-term performance. Sometimes schemes from a single category may dominate the list because that happens to be the flavor of the season. Some may even follow a faulty methodology, so to speak. Interestingly, some people never proceed beyond collecting names of top funds because looking for top funds becomes their favorite pastime. I mean, a lot of us has been there, so don't take it personally. But a lingering doubt about the veracity of the names always holds them back. No wonder many investors keep visiting mutual fund forums for validation even years after they have started investing. Welcome back to the MyFundBazaar Academy. If you are new here, leave us a comment below and tell us what really brought you here today. We'd love to interact with you and get to know you better. I was actually thinking about a quote I read a few days ago by Warren Buffett, and the quote said, "Someone is sitting in the shade of a tree today because someone planted a tree a long time ago." It's such a simple quote, but so effective. In today's webinar, I introduce to all our viewers our investor awareness show in partnership with ICICI Prudential, showing us the shade today in terms of, as you rightly clicked on our thumbnail, the types of mutual funds. It is a happy moment for us at MyFundBazaar to be partnering with ICICI towards this initiative of empowering our clients and viewers on the importance of picking the right funds of their financial portfolio and making holistic, smarter money-making decisions. Now, I'm going to take a moment to introduce the ICICI team today. We have the Head of Product Development and Strategy, ICICI Prudential Asset Management Company Limited, Mr. Chintan Haria, who has been with ICICI for 16 years and anchors driving new and existing products, working closely with respective teams to augment the holistic business growth. His core competencies include research, portfolio management, market intelligence, strategic asset allocation of investors' wealth, and development of products across platforms. Moreover, having received a master's degree in commerce from Sindham College of Commerce and Economics, he is an associate member of Cost and Management Accountancy from the Institute of Cost and Works Accountants of India. He is also a certified management accountant from the Institute of the Management Accountancy of the United States. It is great having you here, gracing the platform with us, Chintan. Now, without further ado, handing over the platform to Chintan to give us his expert insights on the type of mutual funds. Over to you, Chintan.
This is a great platform for all of us to understand more about something which we all should know and learn from our schooling days, college days. But the fact is, even after I finished my chartered accountancy way back in 2004, and I didn't know myself too much about mutual funds. I was just fortunate enough that after my chartered accountancy, I joined ICICI Prudential Asset Management Company, or ICICI Prudential Mutual Fund, back in 2005. And it's been a journey of 16 years where every year I get to learn something new, including last year about the pandemic. So the beauty about finance is that the learning never stops. And from an investor perspective, it is something where the simpler you keep it, the better it is for your own money and investments. Like I started, it is not something which is taught to all of us. Very few of us actually know what mutual funds are. So I'll start with the basics of what a mutual fund is and why is it important as part of your portfolio. Now, in everyday walk of in every walk of life that we connect, be it in school, we have teachers who are trained and who teach us about various subjects, subject-wise teachers as they call it, right? College, it works the same. When we enter a profession, there also exactly the same happens. There is professional training by people who have been doing it for years. But when it comes to our money, we basically either try to do it ourselves in terms of investing the money into direct stocks or into the market without having too much knowledge, because that's not taught to us, or we simply go by what someone else is doing, or what our neighbor is doing, or what our elder cousin is doing, or what our parents tell us. So for us, of course, it is important to note that money grows over time peacefully if you're able to keep it in the right space. And mutual funds is a platform globally as well as in India, which is recognized as one of the best platforms for you to invest. Traditionally, mutual funds in India were supposed to be or thought of as a way of investing only in equity. So think mutual fund, think equity. But the fact is that the 35 lakh crores of money which is being managed by mutual funds, and it is growing every year, uh, about 15 lakh crores is equity, and equity equivalent 20 lakh crores roughly is debt, right? So mutual fund is also a place where you can invest for your fixed income requirements or your debt allocation. And we'll go to that as we move along and we enter the details of which categories, etc., you should look at. So mutual funds are supposed to be that one-stop solution for you to save in a very efficient manner, because it's quite easy these days to invest. You don't even have to step out of your house. Everything is virtually online, and it's also very easy to keep a track of, because the apps, etc., make it very easy for you to see as well. Now I'll come to the basics and move on to the question and answers. What are mutual funds and why are they important for all of you? Think of it as this way: you, along with so many others, have savings. Most Indians love to save. We are a saving country, and we need to invest that money. Traditionally, of course, we've been investing in fixed income instruments, government sponsored schemes, etc., and equities as a smaller allocation. Always of the total allocation or savings of $7 trillion that we have as a country, only 6% is in equities, which compared to US, where there is 40% of the US citizen savings in equity, is much lower. Obviously, the trend is increasing. We're seeing demat accounts in India going from 2 crore to 6 crore, mutual fund folios also increasing. And that is a happy sign, because as the new generation comes in, they will understand the power of equities and they'll understand the power of investing in mutual funds also. So what are mutual funds? Very simply put, mutual funds is essentially a collection of many people investing into a fund. So the investors get units, and the money which the mutual fund manager gets via the scheme is invested in the scheme as per the objectives of the scheme. There are many schemes, like Shruti was mentioning earlier. There are many schemes, and many times people get confused also, so many schemes, how to select. So we'll come to that. But based on the objective of the scheme, the money is invested. The investor, or the person investing the money, the fund manager, is someone who's probably done that or is doing that for a living for years, and is probably more attuned to know what goes into the decision making process, what are the macro and micro variables that need to be seen. any decision that we take, even the smallest decision that we take, let's say for example you're going and buying a car or a bike, you probably try to know the specs of the car, you try to know the specs of the bike, you compare, etc. But when you probably invest in a mutual fund, you go by a simple logic of what's given the best returns in the past, I want to invest there. That's probably not how you should be constructing a portfolio. And that's where comes the advantage of having a right advisor. So if you look at what the platform also brings to you, and what is important to you is that the right advice or the right set of funds should be part of your portfolio. Each fund has its own objective, be it an equity fund. So equity category funds in general invest in equities of the companies in which they probably are investing. For example, large cap funds. Large cap funds are funds which invest in the equity stocks which are large cap, which is top 100 by name in general predominantly. There could be mid cap and small cap funds which are investing in mid caps or small caps. They have slightly higher risk and potential for slightly higher return as well. So they are dedicated towards those companies which are smaller in size and are growing with the economy. And that there again the expertise of the fund manager comes in, because not all companies have the same outlook. Not all companies are in the same business. There are different sectors, there are different segments, and different variables which move a particular set of sectors or stocks. The structure of each mutual fund, as you know, there will be many fund managers. There is a chief investment officer, below which there are many fund managers, and below which there are many analysts. Each analyst covers one or two sectors. So there will be a telecom analyst, there will be a infrastructure analyst, there will be a real estate analyst, who basically in turn cover 30, 20, 30 stocks in that particular sector. So the telecom analyst will be on top of what's happening in the telecom sector. Likewise, the real estate, likewise, the banking and financial sector analyst. Think of it that each of these analysts are only looking at that one sector, the knowledge of which percolates into the fund manager through these analysts, because it is impossible for one person to keep a track of 200, 300 companies, what's happening in different sectors. And sheer, let's say, not just the expanse, but even in terms of will I be able to know about each sector in detail, be it chemicals, be it oil and gas. I used to cover oil and gas when I was an oil and gas sector analyst between 2010 and 15. I knew about my sector well, right? So oil and gas, I'm comfortable. But will information technology, I'll be as comfortable, or pharmaceutical, I'll be as comfortable? The answer is no, because there are so many variables. In pharmaceuticals, what's happening in US matters. They are export oriented. In information technology, what's happening in US, let's say, energy, US banking, and US consumer, because these are the three biggest outsourcers for the IT companies. That's what matters. So there are so many moving parts, and if you think that individually you'll be able to take care of all of these and come out with stocks which are going to do well for you, it's kind of difficult. And that's where when you invest in a mutual fund, you're getting the expertise of that entire analyst team along with the fund manager who've been doing it for years, and that's the only job that they do. And then it percolates into advantage for you in the long run. It is important to have discipline of investing. It is important to have asset allocations, etc., which I'll come to. But that is as far as equity is concerned. But equity mutual funds are not the only mutual funds that are available. There is a category of debt mutual funds as well. So for all your fixed income requirements, etc., or all your debt investments, you can invest in debt category of mutual funds. Liquid money market, we are all aware, they are basically parking instruments. Savings, even arbitrage funds these days are a very popular parking instrument. And then as you move along, if you have a 3-year view, 4-year view, 5-year view, you have different funds like credit risk fund, medium term bond fund, etc. So there are various categories of funds which suit your requirement based on your investment style. Now, as an investor, you will not understand all of these in one go, right? It will be something which is a learning curve, and we'll try to cover that over next few sessions that we do. But this is just a primer that there are equity funds, there are debt funds, then there is a mixture of equity and debt called the hybrid funds, right? Hybrid by nature means equity and debt together. And within the hybrid category, then you have various options that you have, starting from conservative category, which is equity savings category, then balance advantage fund category, then balance category as it's called, and so on and so forth, multi-asset category. The advantage with hybrid schemes is you get equity and debt both in a single fund, and it basically helps you to keep remaining invested for the long term. Within the hybrid category, the most popular category as such in India right now, and which suits 99% of the investors, I would say, if not 100, for their long-term allocation needs is the balanced advantage fund category, or the dynamic asset allocation category as it's called. I will deep dive into that category as we move along. But this category is something which basically takes care of the greed and fear, which takes care of the core pain that all investors see. Typically, what happens? You will notice that maybe a year and a half back when markets fell, you probably wanted to take out money from the markets. Whenever the markets fall, because the market keeps throwing on prices at you every time. The thing about the markets, what separates equity markets, what is the charm that equity markets bring to all of us, right? There are prices which keep moving every second. There are news channels talking about the prices and what's happening, and there are factors which keep impacting immediately. You'll see the price changes, and that also attracts us as human beings in terms of trying to do something. The important aspect in mutual funds is probably, or in investing, is that you remain patient, and remain patient as a long term. There is no single rule by which you should probably invest in mutual funds. Whatever suits you is best for you. But like I said, most investors take out money when the markets fall, invest money when the markets go up. Today, it's probably easy for you to allocate money to the markets. They've gone up for the last 18 months or 15 months or so, and they are at 60,000 Sensex, 18,000 Nifty roughly. So it's very easy for you to invest. But 1 year back or 1.5 years back, when the markets had fallen, you probably froze or didn't have the guts to invest in the market. That's typical of markets. To take care of this greed and fear, you have the entire balance advantage fund category, or the dynamic asset allocation category, which buys when the markets fall, increases equity when the markets fall, which sells when the market keeps going up, and reduces equity when the market value becomes expensive. It's a very interesting category. It's a discussion of half an hour on its own. So obviously, with the paucity of time, I wouldn't want to go in detail too much on that. But it's a brilliant category for all of you, and probably I'll request Shruti that next time when we do this session, we should dedicate it to this, because I believe that this is the core portfolio or core investment that each Indian should have. And on top of this core investment of balance advantage fund category, you can build all the other mutual funds which are available. The advantage which mutual funds bring to you, like I said, equity, debt, hybrid. Then there is gold ETFs as well, gold savings funds as well. So you have the option of investing in financial way in gold. As you know, Indians love gold in general, jewelry, etc. is fine, but then you want to invest in financial assets of gold. So apart from sovereign gold bonds, you have the gold ETFs also, which allow you to participate in the gold as an asset class. It's a popular medium. We've seen investors getting allocated there as well. And so when we have all these categories, and then there is active funds and there is passive funds. So you have active fund management, then you have the entire ETFs and index funds, which is again be a discussion or a topic of its own at a later date. But all the options that you require as an investor virtually in the financial world are available with mutual funds. The only question which you'll have in mind is, okay, how do I start? How do I invest? And what should I do to start with? Should I invest in lump sum? Should I invest in SIP? What is an SIP? SIP is essentially systematic investment plan, which allows you to invest on a monthly basis. You earn monthly, you save monthly, you invest monthly. So there is SIP. There are various variants available in SIP as well. There is daily, or there is weekly, there is monthly. So there are various variants available, and these days the amounts of SIPs have also been brought down significantly to suit and make it available for all Indians, no matter how small your savings are, right? So that's the objective. Even with probably 100 rupees or 500 rupees, you should be able to start saving. The earlier you save, the better it is. So as a youngster itself, if you get pocket money and your parents are giving you pocket money, you may well use it for going out for a movie or shopping. That's fine. Try and save 10-15% of it and try investing. Not only will you learn investing quickly or early, it will also help you in the long run. It will make you wealthier in the long run, and it will make you smarter in terms of managing your own finances. Because unlike anything else, managing finances is not taught to us in a structured manner. And through this discussion, and I congratulate the platform for actually allowing us to have this coordinated effort to create this series to enlighten all of you how you should be investing. So like I said, mutual funds are collective instruments in terms of many people investing in units. It's a very popular medium even in US. In fact, in US, the mutual funds are 4 times the size of the banking sector, right? It is much larger as well. And in India also, it's growing. And mutual funds in general have done a good job. There are risks and rewards, of course, in everything, which we'll come to when we come to the Q&A. And I'm sure there are questions which all of you have, which I think Shruti will ask us. But clearly, as a stepping stone to starting your savings, number one, you should have an advisor who's advising you well on your finances. Number two, with the platform, whatever you want to invest, everything practically is available within the platform. So you don't even need to go out anywhere. Just start investing, just start saving. There are various modes, and as you keep investing, you'll probably learn a lot about the markets as well. And just to highlight in terms of taxation as well, mutual funds are quite comfortable and competitive in terms of taxation. You don't have to pay every year tax on your accrued gains. So suppose you've invested in a debt fund, every year you'll not need to pay tax unless you redeem. So the time you redeem or the time you take out money, based on whether it is long term or short term, is when the taxation event happens. So you don't have to worry about paying tax also every year. Similarly, even in equity mutual funds, for that matter, or hybrid equity mutual funds, only when you remove the money is when the taxation event happens. And if you allow the money to keep growing without the leakage of taxation, you can keep compounding your wealth. There are many nuances, of course, which are there, which can help you in terms of your cash flow requirements, etc. You may want every month a certain cash flow to come in. That is also possible through systematic withdrawal plans. So you park a set of money in mutual funds, which allow to grow in the debt schemes or in the equity schemes. And then after 12 months or 36 months, as the case may be, or immediately after a month, if you want a certain portion, say 0.5% of that corpus as cash flow for your day-to-day requirements, you can do it through systematic withdrawal plan. So it's a one-stop solution. It has options for you to take advantage across based on whatever is your requirement. And hopefully by the end of this series, over the next few months, we'll be able to enlighten you on every small nuance of the mutual fund. So just to summarize before we move to the Q&A, one, mutual funds should be your preferred choice for your savings, be it in fixed income, that is debt, or in equity, because you have options of equity, hybrid, and debt available. You also have gold. Apart from the fact that mutual funds have a very good structure in terms of CIO, mutual funds, fund managers, analyst team, there is an entire ecosystem of brokerages and their sell side analysts also who bring research to the mutual fund, and that also obviously adds a lot of value. And most importantly, consistency and discipline of your investing will ensure that your wealth is created. And we at ICICI Prudential have created a very wide bouquet of products for you to have a one-stop solution across whatever your requirements are. With that, I'll stop, and probably with the questions with Shruti will have, which have been coming from all of you.
Thank you for all the insightful knowledge on, it's like a beginner webinar to mutual funds and understanding it from a wider aspect. And yes, I do hope that we do in consecutive months cover up the importance of mutual funds and head into the types of mutual funds. So thank you so much for that, Chintan. Viewers, if you still have any queries that you would like to be answered, do leave them in the comments below. We will be sure to respond to those. I will now take up a few questions that we had received over the past week during our marketing initiatives that I would post to ICICI to answer them in whatever capacity they deem fit. With that, I'll move on to the first question, which is, when is the right time to start investing in mutual funds according to you?
Today, now, right at this moment. Just go online, go to the app and invest. It can be anywhere. It can be in the debt scheme. It can be an equity scheme. It can be, the choice of a scheme. I'll leave it to you based on your risk profile. But let's say you don't know much. You want to start doing an SIP in a balance advantage fund category, or just invest your money for the long term in the balance advantage fund category to start with. It will give you a good blend of equity and debt. You don't have to think too much. And once you invested, you'll probably get more curious as to what's happening with your money, and you'll probably increase your knowledge as well, right? It's like if you want to swim, you need to enter into water. If you want to drive, you will actually sit on the driver's seat. If you want to invest and learn, better invest. So start today. It's pretty easy. Everything is online, and don't wait. The earlier you start, the better it is. I think Shruti mentioned about a quote from Warren Buffett. He started at the age of 9, I think. And he started with his own money. He used to throw newspapers. He's the richest man in the financial world today, I think, with more than $80 billion of wealth. And he's more than 90 years old, if I'm not mistaken. But he started when he was 9 years old, and his money came by throwing newspapers or, giving newspapers to neighbors, getting that money, buying shares. So he did it at the age of 9. I'm sure we can start at least at 19 or 29, as the case may be. Thank you.
So viewers, there's your answer. Start right now. Okay, awesome. Moving on, what are the true indicators of a risk in any mutual fund scheme?
Where are you investing, or what are the objectives of that mutual fund? That matters, right? So, like I said, if you are investing in large cap mutual fund, it is going to be investing in large cap companies. What are large household brands or names which you and I probably know about, hear about, and we are aware of these? These are companies which have grown over a period of time and have strengths which are there in the balance sheet as well as their business. So they are less volatile, the risk is lesser, and when the risk is lesser in large caps, you'll obviously find that their returns are also steadier, right, compared to mid caps and small caps. So everything is relative in that sense. Typically, debt, which is considered to be a safe asset class, fixed income asset class, so to say, and it is supposed to be a safer asset class, because the risks are lower in debt, you'll probably make lesser returns relative to equity in the long run. So the simple theory is, the higher the risk, the higher should be the return. And that's where a sweet spot of risk and return is found in the balance advantage fund category. So the first risk is the market risk itself. We are in an environment where ultimately the mutual fund, whatever money you are giving, is investing in the equity markets or the debt papers of the companies which are, issuing debts. So it is the real world in which the money is going. So if there is a pain in the economy in the real world, which probably makes the companies, weaker performance, or companies' profitability also weakens, it will get reflected into markets becoming weak, which will obviously percolate into mutual funds. So one is the market risk, right, which is not a controllable risk. We call it the systematic risk, right? It is a system of market. We can't control that risk. The second is unsystematic risk. In other words, right, I have large caps. I have 100 large caps. I can choose any 30 of them or any 40 of them to make my portfolio, right? I may choose the 30, 40 which probably are the best and they do well. Some other fund manager, because he believes a different market cycle is coming in, may choose 30, 40 different companies. There will be an overlap, but maybe some portfolio is different and his performance will be slightly different. So that's the unsystematic risk, which essentially is the fund manager risk of his style not performing. There are different styles, right? Value, growth, and obviously some point of time later we'll try to cover these as well. But the stock selection mechanism which a fund manager may have will be quite different based on his return expectation, based on his assessment of the economy. And that's where one fund manager over the other can have different thoughts, different views, because it's ultimately human, right? It's a human taking that call, and it's a judgmental call which you take. There are objective information which come in, but each objective information can be processed with a subjective mind, which will have a different thought process. Today at 18,000, for example, markets, I may look at it in the way that India is going to grow over the next 3-4 years. We will go from $3 trillion to $5 trillion market cap, and that's great. And so I want to participate and remain invested for the long run. And other fund manager will think, okay, India is going to grow, but are there risks globally which are there? Should I make my portfolio defensive? So I may have an aggressive portfolio because my view is bullish, and the other fund manager will have a bearish view and probably have a defensive portfolio. That's where the idea of diversification into 3, 4, 5 mutual funds or 3, 4, 5 fund managers also comes in, right? And we'll cover that as well at some time. So there are so many topics, so many nuances which are there. But the risks are systematic, unsystematic, and the biggest risk which is there in mutual fund is lack of discipline on the part of you itself. If you are not disciplined in your investing, if you're investing today to make a quick buck in 3 months' time, looking at what your neighbor has made in the past 3 months, and then you end up losing money because markets have corrected. You're basically investing without actually knowing the markets. So the biggest risk is lack of patience on your part. The longer you keep your money, then you allow it to grow, is probably better. So I would say risks are threefold: systematic, unsystematic, which probably is not too much in your control. But what is in your control is your own emotions. And because most human beings find it difficult to control emotions when it comes to money, because there are so many elements which come in. When you start losing money, right, you start thinking, I have my kids' education to fend for, I have my parents, let's say, who are getting old and their expenses, medical expenses. And if I lose this money more, or if the markets keep falling, how will I manage that? And hence you are probably taking out the money. So friends, like I was saying, we can't control the systematic, unsystematic risk. At least you can't control it. But what you can do is diversify your investments, and most importantly, control the risk of probably what you carry within, of greed and fear. And the best way that we found as a solution was the balanced advantage fund category for you as investors, which buys when the market is low, sells when the market is high, and does the job of allocating for you in terms of your overall wealth creation journey. Thank you.
I think that is something we all Indians do. We kind of see what the others are doing, even in terms of investing. And if someone's investing and making a buck out of it, so then suddenly even you want to. So I completely relate there. I mean, it's in the Indian blood. But viewers, I mean, what is your take on this? Are you one of those kinds too? Do you jump onto something and then you get onto a risk, whereas your neighbor might have just got a profit? But that was an amazing answer by Chintan. I think you have really dived in deep into making all of us understand the true risk in any mutual fund scheme, so to speak. So moving on to the next question. Now, this is a question which we have received quite a few times. So this is going to be a very important question for our viewers, which is, choosing a mutual fund is too confusing for me. So what is the right way to go about it, and how do I start?
There are many options. I did not speak about, while I spoke of large, mid and small, then there are sectoral funds as well, infra, etc. So what we've done, of course, at ICICI Pro is create an entire bouquet which will allow you to not worry too much. So be it on the fund of fund side, and then fund of fund itself is a category which will take about one chapter or one such interaction, which is essentially solutions for all of you to invest for the long run. And within that fund of fund bouquet, you have the asset allocator fund, which mixes between equity, debt, and gold, and in the right proportion based on the fund manager. So it's like a wrapper wherein the fund invests in the multiple funds which are possible. So you don't have to do the selection. The fund of fund is being managed by an expert fund manager who does the selection of funds for you in the right proportion between equity, debt, and gold. Then you have the thematic fund of funds, which essentially invest across sectors, right? So the thematic advantage fund of fund invests across sectors. Much too often, Shruti, we've seen investors fall for the theme which works the most. I think you alluded to when you were speaking earlier that the technology fund is doing well right now. Let's invest in technology because last 1 year return is, let's say, 100%. It may do well in the future as well, but that may not be the most efficient way for you to start investing, because every time you're chasing the winner, right, and winners will keep changing over 2 years, 3 years. What will happen is you'll keep being late to the party. And when you're late to the party, you miss out on probably most of the good food that is there in a party. It's just an analogy. But so you want to be early in a theme, not late. And hence the thematic advantage fund of fund is a better way to participate in the sectoral investments, FMCG, infrastructure, information technology, banking. There are many themes, many sectors which are there in India, right? And if you want to be an aggressive investor and participate in those themes, you have to be a bit early, not late. And hence the thematic advantage fund of funds. So if you can't choose it, the fund manager is choosing it via fund of funds. So then many investors want to invest globally, right? Many investors want to invest globally. So again, you don't know whether to invest in US or Japan or Hong Kong or Asia, etc. That's where the global advantage fund of fund, which we've created, is a beautiful tool for you to start investing for your global investments, wherein we choose between developed markets, emerging markets, whether to invest in US, how much proportion. And the good part is that every time we change the underlying fund, it does not impact you in terms of either you having to pay tax or you having to do anything. We're doing it without your intervention. You may be having your own profession, your own business, your own studies for that matter. You don't want to keep looking at the markets and trying to make changes. You want the expert to do it for you. And that's where the fund of fund category. So I spoke of asset allocator fund of fund, which is equity, debt, and gold. Thematic advantage, which underlying you have the themes or the sectoral funds. The global advantage, where you're getting advantage to invest in Indian domestic mutual funds, which are investing outside. And today that theme is catching up. Many people are looking at investing outside, including the Nasdaq for that matter, right? So Nasdaq, US, Asia, there's host of investing that is happening. Just one word of caution: do not get carried away in terms of increasing your investment in any one particular category. So you should have an overall portfolio mix wherein you decide, okay, I want 30% equity, 40% equity, whatever you should choose, 80% equity if it suits your risk profile. And then you divide it. Global investments, I want 15% of my portfolio. Gold, I want 10% of my portfolio. Balance advantage fund, I want 50% of my portfolio. So 10, 15 and 10, that is, sorry, 50, 15 and 10, that's about 75% gone. The balance 25%, I'll keep it in debt, etc. So the whole idea is have a asset allocator plan, and if you yourself don't want to do it, then simply invest in the asset allocator fund of fund and allow the fund manager to do it for yourself for the long run. Of course, there is goal-based investing, and I think there will be questions which people have, that if I have only 8 months money or 10 months money or 2 years money, should I invest in equity today or not? Or how should I go about with it? I'll explain that. But in terms of selection of funds, you need to know the categories and you need to understand the nuances. If you can't, then the fund of fund is a great way. The fund of fund suite which we have is a great way for you to start investing and creating a bouquet for you to probably enhance your wealth as we move along. Otherwise, I would say that pick up 3 or 4 categories which suit you well. Balance advantage fund, like I said, flexi cap fund, is another fund wherein the fund manager can invest in large cap, mid cap, small cap, and that's a good category for the long run. Anytime that you're investing in any fund which has equity, you need to have a 3 or 5 year horizon. If you invest for 1 year, you will be in trouble. And apart from that, just the caution, I would say what you select is fine. What you don't select is important. And don't select those schemes necessarily which have done well in the past, right? That can hurt you. You need to know a little bit more, dig a bit more, especially in the thematic side. See, if a diversified fund has done well in the past, the fund managers had a good track record, good 3 year, 5 year, 7 year. But if a theme has done very well in the last 1 year, for example, commodities, 2 years back, commodities no one wanted to touch. Today, if you look at commodities, they've gone up 80 to 100%. And if you invest today, maybe you'll get gratification for next 6 months. But after that, what happens when the commodity cycle turns? You may not have necessary, understanding to come in and go out at the same, at the right time, and hence the worry of you losing money. So the risks which we spoke of, this is one of the risks as well. So I think be mindful of this and start investing in a simple manner. Once you understand the simpler things, then obviously graduate towards the more complex things. That's how it works in every walk of life. Even in investing, that's how it will work. Thank you.
So start small and start simple. As Chintan has rightly said, viewers, this is just a reminder that this is just like a beginner's course, if I can say, of mutual funds. And we have very many more webinars coming where we're going to dive in deeper into the types of mutual funds and how you should go about investing and all of that. So this is just a reminder for you all to pause this video and hit the subscribe button, because you're not going to miss that opportunity of our future uploads and notifications post this webinar as well. Okay, with that, moving on. Our next question is, for a mid-term investment, which mutual fund should I be choosing, and what is the significance of a fund manager?
One is mid-term. I would assume when the investor has written mid-term, the mid-term assumption is, let's say, 2.5, 3 years to 5 years, 7 years. That's what mid-term is. Short term is anything less than 3 years, and long term is anything more than 7 years. So if the definition of mid-term is 3 years to 7 years or 3 years to 5 years, I would say, given where the markets are, the balance advantage fund is a good fund to invest in. It has lower on equity right now, about 35%. But if the investor wants to, is an aggressive investor and wants to participate in an equity fund, I would say the business cycle fund or the flexi cap fund can be looked at. because these provide good opportunities from an investing perspective right now. The nuances of these fund, of course, are flexi cap can invest in mid and small and large in the proportion. It's a steady state flexi fund, while business cycle is capturing the upcycle in the Indian markets, the cyclical upside in the Indian markets in many of the sectors right now. It is positioned towards the cyclical rally which is happening. But at some point of time, when the cycle turns, it will be able to turn itself into a defensive fund as well. So that's what I would say. 3 to 5 years, we may see the cycle turn, and hence it is important to be in that fund. So I would say Balance Advantage Fund would be my first preference, followed by Flexi Fund and Business Cycle Fund. And of course, the Asset Allocator Fund is something which is again evergreen fund which an investor can look at from short-term, medium-term, long-term perspective. So Balance Advantage Fund or the Asset Allocator Fund both have their beauty in terms of having a good medium, long-term as well as good for short-term. Of course, since they are equity funds, I would avoid investing in them for less than 3 years. The second question, importance of fund manager. It is akin to the importance of a doctor when you're on the operating table, right? The doctor is the most important person. The fund manager is the most important person. He makes the decisions based on whatever he sees in the market, based on whatever is available information in front of him. Also, he brings in his experience of yours in terms of knowing how to manage risk, right? Because in investing, management of risk is more important than anything else. Are we looking at generating the highest possible return at all points of time? The answer is no, because if you try to do that, you may end up increasing the risk so much that you may falter, right? It's like running a race. If it's a 100-meter race, you can go all in, you don't have to worry. But if it's a 400-meter race, and if you start running too fast in the first 100 meters itself, you probably run the risk of, losing steam by the time 250 meters come for 400 meters race. You don't want to do that in investing. And hence, as a fund manager, they see the risk, they see the reward, they see the overall portfolio construct. Typically, a fund will have 25 to 30 securities at least, so you have a diversification in a sector and a stock as well. So all of this, right, where to invest, when to take out money, which sectors to push, is all requires a delicate balance of understanding of the microeconomic environment, macroeconomic environment, and individual stock sectors. It requires morning to evening reading, understanding, listening, meeting managements, listening to analysts, knowing what's happening globally in similar companies, speaking to suppliers, speaking to customers, clients. It's art, but it's a science as well. And like I said, it's more about emotions as well. Most fund managers who can check their emotions, because ultimately they are also humans. So the longer the cycle a fund manager has seen, the better is the long-term output from a fund manager perspective. And hence I would say the fund manager is akin to a doctor on an operating table, the most important person, because he is managing your money, and how he deals with risk and reward will ultimately lead to your gain or your creation. Thank you.
I like the next question because I think even I'm going to be planning my vacation, considering COVID is just going to be a part of life now, a part of our reality. So the next question is, someone has asked us, I have a vacation planned with my family in 8 months. So would now be a good time to invest?
Fair. So if you have saved that money for your vacation, obviously you're not going to be investing in equities with that money, because with 8 months, if you invest in equities, it's like a wager. It may work in your favor, it may not. Because equity markets, you can't predict with a 2-month, 3-month, or a 6-month view. You need to have a longer term view with equity markets. So I would say if it's an 8-month parking that you need to do, then you're better off in debt funds, which have a duration of less than 3 years. So typically the savings fund or even the arbitrage fund, if I may say so, can be your parking vehicle or a parking instrument. Stick to debt funds, stick to lower duration debt funds is all I can say. I can think of the savings fund as a great option, or the floater funds as a great option for you to invest. The floating rate fund or the savings fund, I would say, invest it, park it for 8 months, then take out your money and enjoy your holiday. Thank you.
The next question is rather optimistic. This person, whoever has shared this question, is really optimistic, because the question is, why do I need to plan for my retirement if I've saved enough?
One, if I have saved enough. How much is enough, to be honest, is something which all of us tend to underestimate. Uh, when I was young and my father started saving and putting money in life insurance, that was the probably the mode for most of you who know that maybe 20, 30 years back, everyone used to invest for their children in life insurance. And, it's something which after 30 years would give you a mega sum. So the investments used to be probably 1,000 rupees to 2,000 rupees, maybe 5,000 rupees, which was a lot of money 30 years back. And it would claim to give you 2 lakh, 5 lakh, 4 lakh, depending on 20, 30 years, right? And that 5 lakh rupee used to look good because 30 years back, 5 lakh to 8 lakh rupees would purchase you a house in probably not so far suburb of Bombay, right? So just 30 years back, 5 lakh to 8 lakh, you could think of a 1 BHK in a suburb of Bombay. Today, 5 lakh to 8 lakh probably buys you a bike or buys you a small car. So you can imagine the loss in purchasing power of money. That is essentially what is inflation, right? Inflation, we say, is it eats away your purchasing power. So the loss in purchasing power of money is something which you and I cannot predict. And I have seen that, there was a policy which at that time looked good, and by the time the money came 25, 30 years down the line, a few years back, it probably meant nothing because it was probably lower than, a month's cost or a month's household expenses for a house of 4 people. So, if I have saved enough, why is it important to invest? One, you don't know whether you saved enough. Second is you worked hard for making your money. I mean, you worked hard, you studied or you've done business. You worked hard and you made your money. After making the money, would you want to let the money remain idle and not in turn generate something for you? There are enough probably books or enough columns which you can see where investments are like your third child. If you have 2 children, it's your third child. If you have one, it's your second child. If you have none, then it's your child, which will basically fend for you or which will allow you to live a good life because they will grow and they will take care of you. If you don't invest and you let your money remain idle, and when I say idle, even in pure fixed income, if you let it remain idle, typically the inflation will eat away your money. In fact, you can see it all around. If you have older parents or pensioners around you, the pensions which they receive today, even if they have a good retirement corpus, are they able to deal with or cope with without their children's support with the medical inflation? The answer is no. With the house inflation, or let's say the inflation in which the real estate prices have grown, the answer is no. The vegetable inflation, the services inflation which we are looking at. You visit a doctor today, a simple doctor in Bombay, it's about 1,000 rupees. When I was younger, maybe 20 years, 25 years back, it used to be 100 rupees. So these costs are only going to go up as we see it, and hence don't ever think that I have enough for my retirement, because you really don't know the cost of living is going to increase at what pace. And in India, we are spoiled with probably the lowest cost services, be it doctors, be it telephone, be it internet. Everything is going to get exponentially more expensive. And of course, children's education, because earlier it used to be in India, now it is going abroad. So while you may think it is enough for you, and I'm happy if you really think it's enough, why not just allow it to grow by investing instead of allowing it to stay with you? And hence, investing is very important. It not only supports you but also allows you to probably lower the risk of losing purchasing power of money because of inflation. Thank you.
So that's a lot to learn for us from that question itself. Okay, so I'm going to take up the last question of today, considering the time constraint that we have. So the question is that with cryptocurrencies being the in thing today, should I be investing in those instead of mutual funds?
If you do understand blockchain technology, if you do understand what it means and the kind of nuances that are there in blockchain, if you believe that cryptocurrencies are something which have a future, if you understand them, great. I honestly, being a chartered accountant by background and do not understand too much of cryptocurrencies, so pardon my ignorance as well as lack of knowledge. I tried, but I could not probably put my head around cryptocurrencies. So I would say that if you really like it, it's your choice. I personally don't understand it. It's something which is new. I'm not saying it is right, wrong, but again, keep your asset allocation in check. Don't put all your eggs in one basket. Like I said, having 10% in gold allocation. If you want a certain percentage in crypto because you understand it, might as well go for it. But it's something which I don't understand, and hence I won't be able to comment on it. But what I know is that ultimately, if you look at, if you're worried about money losing its, or the fiat currency as it's called, or paper money losing its value, ultimately it will get reflected in the equity stocks probably getting re-rated higher, or the equities outperforming because their profitability, as money loses value, the profitability grows, and then ultimately your wealth grows in equity. So it's something which you should think of, that if you are worried about the loss of value of fiat currency, based on which generally cryptos are gaining ground, you should also have equivalent in equities, because ultimately the equities will benefit out of, let's say, the inflation-led increase that they will see in profits. Typically in inflation, the profitability of companies grows because their top line grows, and generally inflationary environment good for equities. Whether it is good for keeping your purchasing power same, the answer is no, and hence you should be invested in the right proportion, is what I would say. It's always probably easy to invest in something which has done exponentially well in the last 10 years. But the only word of caution is, if you understand it, go for it. If you don't understand anything, don't invest in something which you don't understand. Thank you.
Okay, with that, we come to the end of today's webinar in partnership with ICICI Prudential. I'd like to thank Chintan and the ICICI team for taking out the time to impart expert-oriented knowledge on the lines of mutual funds, syncing with our initiative of making every Indian financially independent and not base their life decisions just on money alone. We thank our viewers for watching us today and taking out the time to hear us from a financial standpoint. Stay subscribed to our official channel, MyFundBazaar Academy, and continue being a part of these initiatives and, of course, our future webinars, which would be a continuation of the mutual funds. Thank you.